Business owners love hearing what their business is worth. And I got a new perspective from Nicholas Ashford, based in the UK, about the way they're doing investments on MSPs they're looking to buy. This is a bonus episode of The Business of Tech. Well, Nicholas, thanks for joining me today.
No problem. Good to be here.
So you and your organization are investing in MSPs. So walk me through who the organization is and what your investing thesis is.
Yeah, no problem. So the organization is Fordhouse, which is a fund that has, the investors are primarily big family offices. So they're looking after money for generational levels of wealth rather than, quick spurts of cash, which is the traditional sort of private equity fund model. So, and then the overall thesis is B2B essential services, primarily in the UK at the moment. So we're investing into three areas. One area is contact centers, one area is accounting, and one area is MSP. If you look at those, they're all actually pretty similar. Fragmented markets, B2B services, they're pretty essential. There's recurring or repeat revenue in there. So that is the overall thesis. You can see how that fits together.
Okay. So getting a little bit more specific, what kinds of companies, specifically MSPs, are you looking for?
A good question. I'd say in terms of revenue size, roughly everywhere between 2 million and 20 million, which is what in finance parlance is below mid-market. So this is basically small SMBs. My heritage is as an SMB owner, so I've kind of been through that journey. I'm not a high-flying corporate financier who's trying to bring these models down to their level. It's the other way. It's the other way around. I've kind of bottomed up it. So that's the kind of range. Typically, we look for 50% of recurring revenues or more. And yeah, I mean, in terms of location, UK base is obviously, pretty important for us given our investment thesis.
Okay. So 2 million, that's still a sizable organization. Is that a hard cutoff, or are there certain things that from an acceleration perspective you might be looking for? Like how hard is that tier?
Yeah, it's a good question. It's a soft cutoff. So a couple of examples. We've got offices across the UK now as the MSP. So let's say, we've got an office in Aberdeen. If there's another local business in Aberdeen, let's say it's 1 million, but essentially the owner wants to retire and he wants his team to sort of join the team in Aberdeen. It's quite a simple transition. Yeah, love that. Easy peasy. The employees are coming over, the client contracts are coming over, and, very simple deal. So that's a good example. Another example might be, if we're pushing hard on the data analytics and kind of Power BI in the business, and there's a small, almost IT consultancy style business, 5 people, and essentially, you bring in the skill set. You're almost buying the people as much as the client list and the business itself. So again, that could be a smaller business, no problem.
Okay, so I always say in order to understand how these things work, we have to understand everyone's financial incentives. So let's start with your organization. What's the investment time frame look like, and what kind of returns are you looking for on these investments? Because we need to understand that math to understand how the deals work.
Yeah, sure, no problem. So in terms of timelines, because as I mentioned earlier, we've got family offices backing us, which is an intergenerational view of wealth. We have a flexibility around the timeline. In fact, I would say, traditional funds, 3 to 5 year cycles, you're starting to see now more and more pop up, and with slightly longer or flexibility across their timelines, or a lot of them say they are. They don't necessarily actually have that. It's a good marketing spiel, right? So I'd always ask, well, who are your investors backing them? What are their timelines? Because that will naturally flow through. But so, we have optionality on there because they've got that truly longer term view to protecting their wealth there. Having said that, and having just said what I said about 3 to 5 year timelines, a 5 year cycle and 3 to 5 year cycle is a good cycle. And the reason is because you need long enough, you can affect big transformation, but not too long that everyone's on their, we've got a Zimmer frame before they can actually realize any value. So there is a balance there. But the reality is you get to that, you use that as a time frame, you get there, and then you look up and you go, actually, we're going to go again. Let's do another 3 years. Let's do another 5 years. Not dissimilar to a lot of businesses' transformation strategy, I suppose.
Sure, but that gives us a sense that you're looking for those sort of 3 to 5 years of return on the investment. So let's now then talk a little bit about the investment, which I know is what most of the MSPs want to hear.
Yeah,
Now, I want to understand. Let's talk a little bit about the way the deal structures work. I'm not going to necessarily press you on a specific deal, but I do want some numbers.
yeah,
Talk to me about the way you're valuing the MSPs that you're buying.
yeah. So there are two high-level ways of valuing a business. You can look at the revenue and value the revenue service lines and put a multiple against that, or you can look at the EBITDA or adjusted EBITDA and put a value and put a multiple against that. We look at the adjusted EBITDA, and that's our way of doing it. So what you ultimately have is the EBITDA, and the adjustments within that are things like personal costs that may be running through the business, costs that are not needed, that you can get convinced aren't part of the business on an ongoing basis. Another good way to talk about adjusted EBITDA is maintainable EBITDA. So what has to be in there to maintain the running of the business? So if the owner, who's highly operationally involved, adjusts their full cost out, we've got to put something back in, because the business won't maintain itself without that. It's quite a funny one, because sometimes the owners go, well, you've got a bigger business, you're going to scoop this up, you don't need that cost. We're like, that may be true, but you buy the business on a maintainable basis. It is essentially up to us, or upside maybe we would have by having those efficiencies. So that's maintainable EBITDA. Then you apply a multiple. Now that's the magic question, right? What's the multiple? We've all seen those sort of mid-market deals. At the moment, there are some going in the 14, 15 times range. Sorry, we've got to bring everyone down to earth here. If you're in a mid-market deal, so you're chucking out 20 million of EBITDA, even if everything else is the same, you're just going to get a much bigger multiple, because you're just producing more cash. Come down to where we are, that 2 to 20 range, you're probably looking anywhere between 4, 5 and a 7 and 8. Now,
Okay.
yeah, I can go into, if you want, I can explain what makes those multiples go up and down.
Yep, very much so. Let's hear. So what are the key things that would drive that multiple up or drive that multiple down?
Yeah. So I think a big, we talk about revenue quality, and that's big for us. And what that means is, what is your revenue? And I'm going to be completely candid. If you've got a load of VAR in there or hardware, not interesting. It is low margin, it's commoditized, it's not that interesting. So, what's more valuable is recurring revenue. Although, within recurring, there are bands. So if you go, I've got high recurring, but it's just a load of Microsoft licensing, got to be honest, someone can move to a different provider and get exactly the same thing next year. It's still a Microsoft license. Now, if your recurring is, you've got a lot of recurring is your support contracts, that's really interesting. You're delivering that service differentiated product to the customers. They're tied in because they've got support and they're used to it. If you're delivering, comms revenue, so by that I mean connectivity and voice, again, traditionally valuable, but now pretty commoditized, bit of a race to the bottom on price. Teams is eating up all that stuff as well. So, yes, that's recurring revenue. It's not particularly sexy. A really interesting one that will get everyone fighting over is hosted. So, if you're doing infrastructure as a service or platform as a service or desktop as a service stuff, typically very high margin, typically very sticky. But I think we're evolving now from, everyone now has basically is hybrid cloud because of the M365 suite, all the apps that are now basically SaaS. And so that advantage of the hosted being that basically cloud platform is sort of going away. And you have these big CapEx cycles because you need to refresh your hardware. So that's a good one to debate. Who knows? Some people value it very highly. Some people think it's going away. Some people think there's a world where it's going to become more niche. So that's a question mark one.
Okay, so low end, you may be interested in somebody that's got lots of clients and you think you can grow it, but if it's all the Microsoft and the Microsoft licensing and commodity stuff, that's going to skew at the lower end of that range. And then if it's high value service, it's going to go to the end. But that only gets us to a figure
Yep.
that it's based off of. And we all know that in the negotiations, that's not the only lever
Yep.
you're going to control, because payout terms is going to be something else as well. Talk to me about what the payout terms tend to look like.
Yeah, that's fine. So, I'll talk about the typical sort of deal structures. So, you come to an enterprise value. So that is essentially the EBITDA times a multiple, or maintainably EBITDA times a multiple. This is the number we think your business is worth. And then there's the actual construction of the deal. So typically you will have a deferred element. Could be anywhere from 20 to 50%. Why am I giving that range? If you've got one client that's 60% of revenues and the owner is the key account manager for that, I'm going to want 50% because there's a lot of risk there. If it's just a nice span of customers, the owner's not involved at all, and the churn is historically very low, that's fine. We can squeeze it down a bit. Also, if the owner goes, I don't care, I want all the money up front because I've been told you never get any money you don't get on the deal day, you don't get, that's fine. But you're going to get a lower bit, that enterprise value is going to be reduced because the risk is essentially shifting from the owner onto us. So, and just to be clear, that deferred amount, you want to pay that out. Everyone wants it because it's a backstop. It's not a sort of how anyone could get a cheaper deal. It's like, oh crap, if like revenues have dropped by more than, let's say, 10%, in a recurring revenue business over a year, that's, let's say 75% recurring revenue, something's gone horribly wrong. And it by no way makes up for the loss of deal value. It is just a sort of backstop to get the buyers comfortable. And actually, it's more useful at the point of the deal because it's basically the owner saying, I'm sort of saying this isn't going to fall over. That's actually where the value of it, not in the financial terms around that. So that's a deferred element. Other elements might be that obviously you have the money that comes in on day one on completion. So that's typically what the owner gets. And in some situations, that's all his shares. You just pay them out, and they wander off into the sunset and go and play golf in the Algarve for the next 3 years. In other situations, we've had owners that say, actually, I want to leave completely, but I do want to leave a slug in. I think what you're doing is an interesting journey. I want to leave 20% of my proceeds in there so that in the future, when that value comes out, that's passively generating me loads more. And that can end up as a bigger piece than actually the rest of the 80% they took off the table. And then the third scenario, which we've had this, where an owner leaves, they own 80% of the business, they take all the money, but the number two, let's say he's a bit younger, got lots of runway left, he's got 20%, maybe he takes 10% off the table, but rolls 10%, carries on in the business in a leadership position. So now he's carrying on in the business and he's got a slug of equity in that more business. So that is the completion amount. And then the only part we're sort of missing really is the earnout. So in some deals, if someone's looking forward and going, there are these 5 massive contracts, I know they're going to come in, I believe in this, and this growth, then we might sit down with them and say, okay, but you're not there today. You stay in the business and you bring it to what you say you can, then we'll give you value for that. So we'll look into the future and pull that back. All of these are completely flexible. It completely depends on a continuum. You've got someone who wants to run off into the distance today with all the money. And on the other side, you've got someone who's prepared to risk a good chunk of it and stay in the business. And somewhere on that continuum, we figure out through that negotiation process what is important to the seller. And therefore, we flex accordingly.
I think it's implied in your answers, but I want to explicitly ask about it. Are you trying to retain leadership in your best case scenario or not?
Yeah, good question. Honestly, it depends. The primary lever is the wishes of the owner. A lot of the time, the owners, they're 55. This is paid for their kids to go through education. They don't have a pension. This is retirement. They're out. They're done. They've not burnt out, but you're a business owner for like 30 years. It's graft. It's hard graft. And on the other hand, there are people that want to crack on. And if they want to crack on, we make that work. Typically it's a two-way thing. So, I'm thinking of one example where we said, look, we'll get to 12 months. So the person wanted to carry on, wanted to move a slug of their proceeds into the business. And we said, okay, let's have a mutual checkpoint at 12 months. If either us or he wanted to leave, we would just pay out the equity at the deal price he got, and then he's free to go. If we both wanted to stay and carry on, then fantastic. That way, you get to road test and pilot it, and you stayed on and going on to great things. So it's optional.
All right. So when we're talking, it's summer 2022. And we're now, particularly in the US, we're having lots of noise about market slowdown, economy slowdown. I know it's similar in the UK, not exactly, but the two markets rhyme, right? So there's definitely a connection. Are you seeing a slowdown? Are you accelerating? Is it the same? Is the cost of money changing your
Yeah.
deal? Talk to me about the market condition.
I think you've seen uh, down rounds in VC and a lot of kind of it's not looking great there. Typically, private equity follows that, and other funds flow follow that. You've obviously got increasing interest rates because of inflation that sort of pulls money elsewhere. Now, in terms of how that affects the UK, what I would say is I think we're sort of at the peak now, if I'm going to be honest. What I've noticed this year is last year there were lots of MSPs, so not professional investors, but MSPs running around trying to do deals themselves. That conversation this year, MSPs have always said, yeah, we didn't manage to do one. It took up a lot of time. We took our eye off the ball a little bit, or they've done one, a small one. Christ, it's hard to integrate them, isn't it? It's been a bit of a mess. We had a micromanaged culture. They had a full autonomy culture. So I think that has disappeared a little bit. I think the professional investors are still there, but I think the sentiment is, we've seen multiples creep up over the last 2-3 years, and I think it feels like they're sort of plateauing. Now, there is a lot of dry powder, i.e. money that investors have given to private equity firms and stuff. So that money still has to get spent. So I don't think it's going away anytime soon, but new flows of money, I think that's going to tail off a little bit, if I'm going to be honest.
Okay. So I'm going to give you an example MSP. This way we can talk a little bit about
Sure.
numbers and we can give people something to work off. So let's talk about a sort of 2.2 million. I'll speak in pounds, but it doesn't matter for the listener. The point is, so 2.2 and turnover, by the way, would be the British phrase for it rather than annualized revenue. But so let's say 2.2 million turnover. And it's at about 184K a month in a recurring model to that. But they're doing about 12% to the bottom line. Talk me through the questions that you're going to ask and the way your thinking would go on that example model.
So, 2.2 million, it's not a huge deal. So in terms of that thing I said right at the beginning, in terms of that EBITDA, it's going to be the lower end just because even if you took two businesses exactly the same, it's just producing less cash if you float it down. Still, by the way, great business. If you're a business owner, that's turning over serious lifestyle bits of cash. I be really clear. There's a kind of a double lens there. So we go. Let's say the business owner says, let's talk. So typically, we'd ask a few questions. One we've talked about earlier, which is revenue composition. What's percentage support? What percentage is subscription, hosted, professional services, comms, etc. So there's that piece we talked about. Other things we really care about are customers. So customer concentration, largest customer, top 10 customers. Now, this is interesting. I think if you're an MSP, buying an MSP, you freak out if they've got lots of large customers because that's risk. If you're slightly bigger, such as us, as long as you can get comfortable, those customers aren't going anywhere. Bigger customers, they're going to spend more on digital transformation. They're going to take all your services. They may be expanding. So actually, we quite like that. So look at that. Contracts is an interesting one. A lot of people buying businesses care deeply. They want 3 to 5 year contracts, lock in the customers. We actually take a very different view, which is if someone is unhappy in a 5-year contract and they're 1 year in, they're just it's going to end. It's not going to carry on, and therefore we just look at the churn rate. We bought a business 6 months or so ago that had a 90-day contract period for all its customers, i.e. no contract. You give notice and leave. The churn rate was so low, completely comfortable with that. So that contract thing. The other thing we look at is we bucket customers. Of your customers, what are the buckets of spend? They're 50 to 100K. If you've got any 100K above, again, we prefer fewer big spenders. Perfect business would be they had 10 customers, all contributing 10% of revenue. That would be the dream for us. So no one is scary big, but everyone's a big chunky customer in that 2.2 example. Outside of that, we look at pricing just to make sure that the gross margin, always a tricky one. Some MSPs will stick all their support desk people into cost of sales, which I think is the correct thing to do. Some people stick it all in overheads and say they've got a fantastic gross margin. But what we look there to check is you're not selling stuff at a low price. So you're not just chasing revenue, and that obviously follows through to EBITDA. So those are the things ultimately we look at. Other than that, If they've done lots of acquisitions themselves, there's normally a bit of a long tail of tricky stuff at the back, not too keen on it. If they've got a long tail, they've got 300 customers just with the broadband line, again, not that interesting. Sector-wise, pretty agnostic. So yeah, those are the kind of things we look at, and that will sort of make our decision in terms of the valuation. Now, other stuff in professional, just to make the point, in professional services or projects, we want to call it, there's a lot of variation in that. Projects to install your Wi-Fi network, yeah. Projects because you're doing a Power BI project, you're doing a data analytics project, you're doing a dynamics project, that's really interesting. So there's a variation in that, but those things all together kind of provide the value for the business, and then it's about people. First of all, people and culture. If the fit's not right, it's a straight no-no. Don't care how good the business is. It's so hard to integrate businesses. If the people and culture isn't right, it's just not going to work. But outside of that, it's leadership. Can the business run its own? Is the owner doing 2 FTE, and are they basically the salesperson as well as? Because by the way, they'll all say no, they're not. They're not involved at all. But when was the last time you picked up the phone? When was the last time you were called on holiday? Things like that, and it all comes out in the wash. So that stuff is important as well. Because if you put whatever the value you put on that owner, you then have to replace them or not replace them, and you're timesing that cost by 5, 6, 7, whatever it is. That's a big number. That's a big number. So that makes a big difference.
Okay. So I want to ask, because when we initially talked, you were very focused on EBITDA, and then I gave you the example, and I gave you both a revenue number and an EBITDA number, and you jumped right to the revenue number. So talk to me about the impression and your take. Why do you go that way, and what's your impression of the EBITDA number that I threw out in that example at 12%?
Yeah. So, okay, that revenue focus is making sure that the business is of a quality we would even look at it. Then it becomes about EBITDA. So that is like the pre-filter. So assume you've got that pre-filter. You said 12%. So I'm very privileged. 12%. I get to speak to tons of MSPs. I would say anywhere between 5 and 15% is about normal. So 12% is probably bang in the middle, give or take. If you're doing 20%, world-class business. You're doing more than that. I'm sorry, I don't believe that that's sustainable. You're running the business hot. You've probably stripped it for sale. The exception being you've got a ton of hosted on your platform where you're generating this super high margin recurring revenue. But in that case, I'm not going to look at EBITDA. I'm going to be EBITDA plus CapEx, because true CapEx is a one-off spend. If you've got to renew your servers every 3 years, that's sort of a gray area between operational spend and CapEx spend. I could divide it by 3 years and say every year that is a cost that comes in. So that's, sorry, slight side tangent, but so that's kind of how we look at it.
Okay, so then what's the biggest warning sign in due diligence for you? The number one thing that always scares you off from a due diligence perspective?
I think the ultimate. So I think there are 2 things. I've mentioned the first one, which I think if you've got an EBITDA margin of sort of above 25% or above, I think your business is running extremely hot, and we're going to take a step backwards when we buy the business. So if I buy it at a 6 multiple, in reality, it's going to be 7 by the time the business is relaxed. I think the other big one is the presence of lots of mergers and acquisitions. Whilst it's something we do, we understand it, a lot of businesses take the view, we'll just bring them all together really quickly. We're going to lose 20% of revenue, but get it done, and then ultimately try and look for an exit. We actually take the view, we spend a long time on integration. We lend resources from Fordhouse to the MSPs to help them get integration right. I can talk about that a little bit more if you want, but therefore, we believe most other people don't do integration right, and you get a long tail of crap that ultimately will come out and bite you and has to be unpicked. And we don't want that work. I'd rather have a clean business that's been built organically.
How hands-on are you with these businesses once you've acquired them?
And I think this is one of the areas we differentiate. So most funds or private equity people are essentially capital allocators, i.e. they raise money off investors, they put money somewhere, and then they turn up at a board meeting once a month and shout at the business owner. What we believe, and this is because of our SMB heritage, is actually integration is really, really, really hard. I call it the M&A iceberg. The bit you see, the shiny white bit on top of the water, is the deal. Everyone talks about it. Everyone sees it. It's sexy. It's cool. Deals, exits. And then you have this hulking mass underneath, which is 6 months to 2 years of integration. And that's what your boat's going to hit and sink on, right? That is going to be the thing that kills you. And so what we do is we lend down basically world-class resources from Fordhouse at integration to work really closely with the MSPs to make sure they bring the businesses together really, really well, and over time transfer that capability into the business as well. The analogy I always use is, football player and football manager. You may be great at a business owner of organic growth. You may be a really good footballer. M&A is like being a football manager. It doesn't necessarily translate because you're good at one, you'll be the other. You might be, but you might not be. And therefore, helping these business owners with that is one of our primary focuses. So we are operationally involved there. We also can help around, that's our primary focus there.
Okay. So what advice do you give to owners who are thinking about selling? What's the best way for them to prep to have the conversation with someone like you?
I think there's a couple of things. I think get ahead of it, 2 years minimum. It takes time. They should get themselves out of the business as quick as possible. It's painful. Most business owners are control freaks because that's why they built this great business, because they basically grabbed it and dragged the thing into existence and beyond. Build a relationship. So, I speak to lots of people that want to exit now, people that are 3 years through a 5-year plan, and people who have no intention to sell for the next 10 years because they're 44. But if you have that relationship and you can follow the journey, so I'll have an annual or 6 monthly or whatever it is, catch up with people, and you can see that they hit their targets, they're following their things. That then means that's a high quality business. When you want to come and buy it, you've already. It's not a story because it's true and validated. It's a journey that I've been on. So with the owner, so I think that's one point, or a couple of points. I think the other thing, which is when you get to the deal, and get good advisors. Do not go to the lawyer you're using, say for your customer contracts, and say, by the way, can you help with this deal? Because of course they'll say yes, but shooting myself in the foot slightly, you want a good lawyer that ultimately is experienced specifically in M&A and can help you and ultimately tell you what market is, i.e. what's normal and what's not. So you have all these deal terms and this, kind of pro forma stuff, and they can go yes, 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 no, no, no. Whereas your average Joe lawyer won't know that because they just won't have done 30 M&A deals that year. And your owner, it might seem sensible, but it's not, it's not a great term or whatever. So I think those are the key points I'd focus on.
Well, that gives everyone a lot to think about. Nicholas, if people are interested in getting in touch with you,
you can
find
me on LinkedIn. So it's Nicholas Ashford Fordhouse, or NJSA at Fordhouse.team. And always just willing to have a convo. Lots of people I speak to just want info, kind of see what's going on in the market. It doesn't mean if you speak to me, it's the business is on the block tomorrow at all.
Awesome. Well, Nicholas, thanks for joining me today. Thanks for your time and attention. Time is a finite resource, and I really value you giving me some of yours. If you like this video, you can let me know with a like of the video, and even more valuable, hitting the subscription button. My content is all free, and I use metrics like subscriptions to pay the bills, so it has real value. The content here is produced under ethics guidelines posted at businessof.tech. If you're interested in more content like this, you can get access to content early via our Patreon at patreon.com/MSPradio. It's our give what you want model where you set the value of what you think the content is worth. If you like this podcast, you can catch it daily as the 5-minute news and commentary show, The Business of Tech, available on all your favorite podcatchers with links at businessof.tech. Just hit that big blue button to subscribe. Again, thank you for taking time out of your day to listen, and I really value the interaction. If you want to say something in the comments, I do respond and watch all that, and I look forward to talking to you next time.